Real estate investment trusts were among the worst performers during the Fed's rate hiking regimen from early 2022 till really the beginning of July of 2024, just a few months ago. And the reason for this is simple. Interest rates were rising, and REITs are very interest rate sensitive instruments. That's because they are very dependent on borrowing as well as raising equity capital from the capital markets to be able to fund their businesses. They, by law, have to pay out at least 90% of their taxable income, so their retained cash flow is quite a bit lower than many of their C corporation peers, and so they have to go to the market to be able to raise capital to grow their businesses. So they're very capital intensive and capital market sensitive. And so that's one big reason why, as their cost of capital went up, their growth rates were expected to go down, and therefore their stock prices went down. And that was a vicious cycle, because as your cost of capital of equity then goes up as well as your stock price goes down, combining with your increased cost of debt to just start a very negative vicious cycle of ever spiraling higher capital costs. And so businesses, especially REITs that had weaker business models, were often put into a tough spot because they had all this debt they had to refinance at a much higher price interest rate than they had previously. And so that hurt them a lot. Another reason why was simply the fact that they're viewed as bond proxies because of their high dividend yields that they pay out, their long duration contracted cash flows, and they're more defensive in nature, many of them, especially triple net lease REITs like, for example, Realty Income or WP Carey. And so with higher interest rates, the market expected a higher dividend and cash flow yield from these REITs. And so that also pushed down their equity valuation. So that was kind of a perfect storm that hurt a lot of these REITs. Additionally, the AI boom was going on. It began in earnest really in early 2023 and has continued really to the middle of this year before it's somewhat peaked and tapered off some recently. But that was sucking a lot of capital away from more boring, slow-growing, unexciting stocks like REITs and pushing it into the stocks like NVIDIA, Palantir, Microsoft, etc., and driving that side of the market much, much higher. And many also were just thinking, well, we could be facing a recession. We've got uncertainty of the elections coming up, and so we're going to put capital into just cash, and that's a much safer place. Or maybe even Bitcoin was a craze there and still has been popular recently. And so that also was sucking money out of the REIT market. So for all those reasons, REITs were a bad performer. However, REITs recently have recovered, and since early July, they've been one of the strongest performing sectors, crushing the S&P 500 and tech stocks over that period. But I believe that further upside is ahead for REITs, and in this video I'm going to discuss why. Before I get into that though, if you could please give this video a like, it would greatly aid in its distribution and help me grow my channel. Thank you very much. Okay, so why do I believe that further upside is ahead for REITs even though they've already outperformed so much? Well, it's simple as looking back a couple years before the 2022 sharp downturn in the REIT sector. And many of these REITs over the past couple of years, yes, their stock prices have been volatile. Many of them are quite a bit lower, yet at the same time, they have continued to grow and compound their cash flows over that period of time. They've been growing their FFO and AFFO per share at a steady clip, because even if they haven't been able to raise a lot of capital, they're still retaining some capital, and they've been able to reinvest in new opportunities. And many times they've been able to reinvest these retained cash flows at a much higher spread than they would have previously, because again, with higher interest rates, cap rates are going up, there's lower demand for properties, and so sellers are more willing to do deals. And so there's that advantage for them as well. Additionally, they've continued to focus on paying down debt, so their balance sheets are in better shape than ever, because the high interest rate environment forced them to get more serious about keeping their interest payments down, deleveraging their balance sheets. And so for that reason, they're also quite a bit more, much stronger position. Additionally, overbuilding has been tackled because of, again, these high interest rates, less developments in the residential space. Retail already got hit hard with the Amazon disruption as well as the COVID-19 outbreak. Office properties, of course, there's like no development there. And there's a lot of office properties being converted to other uses. And so a lot of the excesses, both in terms of debt and overbuilding, et cetera, have been cleaned up. And so the real estate market fundamentals right now are arguably much stronger than they were a few years ago. And as interest rates come down, that's going to solve really the one major lingering concern. That's all this debt that's going to be maturing in the next few years that was underwritten at much lower interest rates. But if rates fall, they'll at least not be as much of a headwind. And so there are a lot of reasons to be much more bullish on real estate today than a few years ago. And their dividends are higher too. And yet most of them still trade at lower stock prices than they did a few years ago, and certainly lower valuation multiples. And so when you combine all those things, I think that there is meaningful further upside ahead for REITs. And Another reason to like REITs is simply the fact that we're at a point in the world right now where there are growing concerns about international geopolitical tensions. There's more onshoring to the United States. There's more deglobalization, more manufacturing and other infrastructures coming back to the United States. And so that also is creating incremental demand for commercial real estate, especially in the industrial space. Meanwhile, it also means that REITs that are focused in the US or Canada or somewhere domestically, away from Asia or even some riskier places in Europe, they are now more of a safe haven investment as opposed to investing in some multinational corporation that has high exposure to China or at least trades with a lot of businesses and is heavily dependent on, say, semiconductors or other elements that are essential through the Chinese or the Taiwanese supply chains. And so REITs are a nice safe haven of sorts from that. And so that's another reason to like REITs right now. Now, with that being said, we're not just buying any REIT, right? I'm not just buying any REIT that's out there, or even personally, I'm not just buying REIT ETFs, although that's not necessarily a bad way to go. What I'm doing is I'm being very selective, and I'm picking REITs that I think are going to not only benefit from lower interest rates, but potentially do well in a stagflationary environment. As I discussed in my past video, I do think there's a risk of stagflation, where inflation being a little bit higher for longer, potentially the economy weakening a little bit. And so which REITs are those that I like? Well, I like multifamily. I like inflation indexed triple net lease REITs. Those are my two favorites right now. And so I think some great opportunities are, for example, BSR REIT. I've posted a lot about them in the past. They're a multifamily Class B property REIT that's focused in niche Sunbelt markets, especially in Texas. Attractive long-term population growth dynamics, defensive against the risk of a recession, pays a nice dividend yield, just hiked it over 7%, strong balance sheet, trades at a significant discount to net asset value. Insiders are very well aligned with shareholders. Good opportunity. I've owned it since earlier this year, made a lot of money off of it, and I think there's still further upside ahead. Another one I like right now is Mid-America Apartment Communities. It's basically a much larger, even a bit stronger balance sheet, a little bit less exposure to Class B though, and a little bit more tilt towards Class A, but still, a lot of concentration in the Sunbelt markets, multifamily REIT, great track record. I also think they're a decent play right now. Another one I like is Armada Hoffler Properties, and their stock, as I'm filming this video, just declined by a significant amount yesterday due to an equity issuance. But that equity issuance is strengthening their balance sheet and setting them up for longer term attractive growth. And so right now, I don't own shares yet, but it's looking attractive. I might buy some soon because they've solved their biggest weakness, which is their balance sheet issues with that equity issuance. And now the stock price is even cheaper. The dividend is still well covered by cash flow. It yields over 7%. What's not to like? They're a mixed use REIT. They have high concentration multifamily, and they're continuing to grow that. That's complemented by a portfolio of Class A office real estate that's actually done quite well, still has very high occupancy. And they also have some attractive retail real estate. And so they have all these mixed use communities where you live, work, play, retail mixed with office, mixed with multifamily, very attractive markets, very attractive assets, doing very well. Seems like a pretty sharp management team. I think that's a great opportunity to buy quality real estate at a steep discount to its net asset value. So that's another one I like right now. Of course, I like WP Carey too, as I've mentioned in other videos. Not the greatest REIT in the world, but they have a nice yield that's quite safe, will very likely grow in line with AFFO moving forward. They've got a strong balance sheet, BBB plus credit rating, good liquidity. They've got, the biggest thing I like though is that their triple net lease structure, which is well diversified with quality industrial and warehouse real estate. So again, very defensive against an economic downturn, but they have CPI linked rent escalators on the majority of their rental income. And that means that they're well positioned to do well in an environment where inflation is a little bit higher for longer. If we go into stagflation, they're a great opportunity. So those are some of the REITs I really like right now. Hopefully this video was helpful for you. If you liked it, if you could give it a like, subscribe to my channel, and let me know in the comments below which REITs you like right now. What is your outlook for REITs moving forward? Thank you very much. See you next time.